Hi, and welcome to Swissquote's Daily Market Talk. It's Thursday, October 9th. Major US indices advanced to fresh all-time high levels yesterday, led by strong appetite for technology and AI stocks. Then gold also soared past the $4,000 per ounce level on weakening appetite for traditional currencies, all of them. Meanwhile, the Federal Reserve expects to further lower the interest rates in the coming months, but Fed members look increasingly concerned about inflation risk, as you know. But the US government remains shut and the economic data is simply not coming out. So investors' attention in this environment is shifting towards company earnings for fresh hints about where to go next. So we will talk about all that and more. But before we do, please keep in mind that opinions are my own and this is not financial advice. With little surprise, major US indices went on to print fresh all-time high levels yesterday, again fueled by technology and AI. In fresh news, Elon Musk's xAI secured $20 billion funding from companies including Nvidia, which by the way didn't finance the whole of it. My bad for yesterday, but only around $2 billion of it. And SoftBank bought the robotics division of the Swiss ABB, intensifying its bet on what it calls physical AI, which they actually believe is going to be the next big thing within the AI sector. So investors loved it, to say the least, because SoftBank soared 10% today in Tokyo, helping the Nikkei index as well remain bid near an all-time high level as well. Also, wait, I'm not done, because Dell earlier this week doubled its growth estimates for both sales and profit for the coming 2 years, saying that, well, they were actually wrong about how big they thought the AI market was 2 years ago, and that it is nothing but bigger. So that was also a comment back by JP Morgan CEO Mr. Jamie Dimon, who also acknowledged this week that the demand for AI has turned out to be far stronger than many out there anticipated. He actually revealed that JP Morgan is now spending about $2 billion per year on AI initiatives, and strikingly so, he claims that those investments are already being offset by equivalent in cost savings. So again, I will not be defending here that the AI market and the technology stocks are not in a bubble, but I don't see where the reports that AI is not worth investing and it's not giving any revenues are coming from, to be honest with you. Anyway, the AI rally continues full speed in the US and outside, with Nvidia up by 2% yesterday. Tesla, that wants to internalize xAI, also printed a 1.30% gain yesterday. Then Dell jumped 9%, and the Nasdaq 100 index pushed their fresh record high level above the 25,000 mark. And all that, while the Federal Reserve minutes yesterday hinted at further interest rate cuts down the road for the US, but with many Fed officials still worried about inflation risk due to tariffs. So that means that any heating in inflation data has the power to reverse or to tame the Federal Reserve's easing path. Now, the good news is, no data is being released right now that the US government remains shut, so the US 2-year yield that best captures the Fed expectations remains kind of steady, a touch below the 3.60% level, while the US 10-year yield is sideways following a $39 billion debt sale yesterday that remained just short of market expectations. Now, in the FX space, the US dollar is softer this morning in Asia, but softer after having bounced to a 2-month high on the back of even weaker appetite for the euro and the Japanese yen. The Kiwi, on the other hand, rebounds after hitting its lowest level since April this year, following a surprise 50 basis point rate cut from the Reserve Bank of New Zealand earlier this week that also actually left the door open for further interest rate cuts in New Zealand, arguing that the economy's weakness has become just too pronounced to wait, and inflation in New Zealand is showing signs of easing as well. In the same context, Poland in Europe also unexpectedly cut the interest rates this week, pointing at easing inflation there, while the Bank of England warned yesterday that the stretched valuations for AI companies and rising worries about the Fed's independence increase the risk of a sharp market correction and could eventually pose instability across global financial markets. Now that's quite funny, obviously, because the UK has such a small exposure to AI and technology and has instead huge budget issues to take care of. So the latter went somehow quite unheard by investors yesterday. Sterling remains very much unloaded into this autumn budget announcement, and even though the French political shenanigans with Macron now again expected to announce a new prime minister in the coming hours helped keeping the upside in the euro pound since the end of September, the outlook here remains more supportive of the continental European currency than the United Kingdom's, where sluggish growth, persistent fiscal pressures, and a hesitant Bank of England actually continue and will probably continue to weigh on sentiment. Now, one place where there is no place for hesitation is gold. The bullion finally soared past the $4,000 psychological level yesterday, and that on the back of a very much diminished appetite for traditional currencies, including the US dollar, the euro, sterling, and the Japanese yen, on the back of strong central bank buying for gold, and now on the back of uncertainties around the US government shutdown as well. So all of these factors remain in favor of gold bulls. Now, one question that constantly comes up is whether gold has more room to run from the actual levels. Now, unlike equities, we don't have ratios like PE ratios and valuations to judge whether gold has become too expensive or not, because this is a safe haven asset. It also has a solid fundamental demand, mind you, in the physical world, and that includes the Chinese Golden Week right now and the Indian wedding season, and that is also helping, but that's just a minor part of the story, mind you. The big part in this gold rally is actually explained by investors thinking that it has value. How much value? Now, as much as people think it has. I mean, if one Bitcoin is trading past 120,000 US dollars per coin today, gold sure has endless upside potential as well. So yes, even with the record high levels in gold prices, gold outlook remains positive in the medium run and the fundamentals remain supportive. Now, many investors already eye a further rally toward the $5,000 psychological level, while Glenn Coxon from NFG Partners highlighted in our latest quarterly outlook, if you didn't watch, I really recommend you to go and watch it, the possibility that the gold rally could be only halfway through and that we could see levels as high as 7,000 US dollars for the bullion. Now, today, and in the absence of US economic data, investors will be shifting their focus towards the first batch of US earnings with results from Delta, Pepsi, and Levi's due today and BlackRock due tomorrow. Now, the spotlight will be on how these firms are navigating a still resilient economic environment, sticky costs, and shifting interest rate expectations from the Federal Reserve, all of which could actually set the tone for sentiment heading into the heavier part of the earnings season, of the reporting season from next week. Now, note that earnings expectations have improved over the past weeks for the S&P 500 companies, and the S&P 500's big companies are now expected to print around 6.3% revenue growth and a nearly 8% profit growth in the third quarter of this year. And if we look across sectors, technology stocks, technology companies will continue to do the heavy lifting with a 21% profit surge expected from them thanks to AI-related demand, unsurprisingly. Then utilities and financials are expected to print 17.5% and 11% rise respectively, while energy and consumer staples are seen printing 3% decline in their profits due to the trade war and also the falling energy prices. So let's see what the companies and their heads have to say. But this is all for today. I'm İpek Özkardeskaya, and thank you for joining me, and thank you for all your beautiful and supportive comments. I hope this episode of Market Talk has been helpful and it has been insightful to you. So please do not hesitate to leave your comments your reactions and your questions below as usual. Follow us on Instagram, on X, on LinkedIn, but also on WhatsApp, Threads, Telegram, and Blue Sky for regular market updates. Subscribe to our YouTube channel for daily market comments, and please don't forget to hit the like button on these videos to let us know that you enjoy them. So I will meet you again tomorrow, and until then, good day trading.
This content is intended for individuals who are familiar with financial markets and instruments and is for information purposes only. The presented idea, including market commentary, market data, and observations, is not a work product of any research department of Swissquote or its affiliates. This material is intended to highlight market action and does not constitute investment, legal, or tax advice. If you are a retail investor or lack experience in trading complex financial products, it is advisable to seek professional advice from a licensed advisor before making any financial decisions. This content is not intended to manipulate the market or encourage any specific financial behavior. Swissquote makes no representation or warranty as to the quality, completeness, accuracy, comprehensiveness, or non-infringement of such content. The views expressed are those of the consultant and are provided for educational purposes only. Any information provided relating to a product or market should not be construed as recommending an investment strategy or transaction. Past performance is not a guarantee of future results. Swissquote and its employees and representative shall in no event be held liable for any damages or losses arising directly or indirectly from decisions made on the basis of this content. The use of any third-party brands or trademarks is for information only and does not imply endorsement by Swissquote, or that the trademark owner has authorized Swissquote to promote its products or services. Swissquote is the marketing brand for the activities of Swissquote Bank Limited, regulated by FINMA, Swissquote Capital Markets Limited, regulated by SISEC, Swissquote Bank Europe SA, regulated by the CSSF, Swissquote Limited, regulated by the FCA, Swissquote Financial Services Limited, regulated by the Malta Financial Services Authority, Swissquote MEA Limited, regulated by the Dubai Financial Services Authority, Swissquote PTE Limited, regulated by the Monetary Authority of Singapore, Swissquote Asia Limited, licensed by the Hong Kong Securities and Futures Commission, and Swissquote South Africa Limited, supervised by the FSCA. Products and services of Swissquote are only intended for those permitted to receive them under local law. All investments carry a degree of risk. The risk of loss in trading or holding financial instruments can be substantial. The value of financial instruments, including but not limited to stocks, bonds, cryptocurrencies, and other assets, can fluctuate both upwards and downwards. There is a significant risk of financial loss when buying, selling, holding, staking, or investing in these instruments. Swissquote makes no recommendations regarding any specific investment, transaction, or the use of any particular investment strategy. CFDs are complex instruments and come with a high risk of losing money rapidly due to leverage. The vast majority of retail client accounts suffer capital losses when trading in CFDs. You should consider whether you understand how CFDs work and whether you can afford to take the high risk of losing your money. Digital assets are unregulated in most countries and consumer protection rules may not apply. As highly volatile speculative investments, digital assets are not suitable for investors without a high risk tolerance. Make sure you understand each digital asset before you trade. Cryptocurrencies are not considered legal tender in some jurisdictions and are subject to regulatory uncertainties. The use of internet-based systems can involve high risks, including but not limited to fraud, cyber attacks, network and communication failures, as well as identity theft and phishing attacks related to crypto assets.